Hi, guys. Welcome to the 19th episode of the weekly trading wrap up, WTW for short, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Crazy week. Actually, crazy day on Friday. The beginning of the week was fairly well behaved until Friday, where this candle destroyed everything. So, as usual, we will start with a picture chart of the S&P 500 daily. This arrow denotes Monday, Tuesday, Wednesday, Thursday, if you can see it, and this big Friday sell-off on the penultimate last day of the month, I guess, of March. So first, let's talk about the technical picture. Then we'll get into the macro. And on the third part, we'll talk about some miscellaneous stuff that I noticed and would like to talk about more in detail. Okay, so first, the technical picture. Okay, obviously, the technical picture right now is bearish. Okay, we can see this because let's get in some moving averages. The most important is the 200. Okay, we broke below the 200, retested it, and this served as resistance. On Monday, we gapped up on positive news that tariffs are not going to be that bad. They're going to be targeted instead of like shotgun tariffs across the board. So the market gapped up. It was a very nice day. However, it hit the 200-day moving average, which served as resistance, and then it went down. Okay. If it wasn't for Friday, today's action, I'm recording this as usual on Friday after market close. If it wasn't for Friday's action, this would have been a very constructive day. If Friday was like flattish or whatever, this would have been a very constructive week and day. Still under the 200, but waiting for an up move above it. Okay, and I was hoping like Monday, Tuesday, and Wednesday that we would close the week above the 200, which would be a bearish sign, and we can continue going higher. However, as you can see on Friday, it spoiled everything. Okay. So technically speaking, we are at the point where we have to switch it to bearish simply because it's still trading below the 200. It's been under the 200 for a long time, and Friday's action confirms that there are still a lot of sellers in the market. Okay, now what do I think is going to happen on next week in regards to the technicals? Well, I'm thinking that we still, well, first of all, let's talk about what we have now. It's bearish, but we still have some cause for hope because it is a higher low. We could consolidate and go higher. Or what I think is going to happen Monday is that there's a lot of sellers that came in on Friday. Let's go to the 15-minute chart so you can see more clearly. Okay, so selling the whole day, but towards the end of the day, this is starting around 1:30, 2 o'clock. Towards the end of the day, there's a lot of supply that was being sold, but buyers started stepping up. Okay, is that enough to go? It's just one day. We don't really know, but buyers were enough to stop the decline after 1:30. We're going to get to why the decline happened in the macro section, but for now on, just looking at the technicals, we see that technically speaking, Friday there was a little glimmer of hope for the bulls. Let's go back to the daily. Little glimmer of hope for the bulls that the sell-off might be over. However, I don't think so. I think on Monday we come and we gap down open, maybe even penetrate the 550 low that we had a couple weeks ago. Because this gap down would probably like signify, hopefully, some kind of exhaustion low with high volume like we had here. On August 5th, this was classic. Gap down open, massive volume, and then you had that snapback rally. Okay, we never had that. This entire time, we never had like a gap down open on massive volume. We had massive volume on every day, but it was sellers and buyers duking it out with the sellers winning. So here we had a Friday that was pretty high volume, finished at the lows. So the selling is probably still not exhausted yet, and markets rarely bottom on a Friday. So it could happen early next week, on Monday or whatever, maybe Tuesday. Who knows? We might get like 2 gap downs. Who knows? But I think we're going to continue the sell-off. Hopefully it's on Monday and the buyers step up. Okay. Otherwise, this is looking bearish, but not 100% bearish where we break these lows and we finish low we finish at the lows for the entire week of next week. So, in conclusion, for the technical section, bearish, okay, with a slight hope for the bulls, okay. However, as we all know, we are still in extreme negative sentiment, okay. Let's go with the AAII. Came out, we are still at extreme bearishness, okay. And same thing for the fear greed index. Back to extreme fear. Everything is at extreme fear, okay. So the technicals are being sold, bearish, still at extreme fear, and the AII is 5 weeks of extreme fear and very little bullishness. Even though it recovered a bit this week, I'm pretty sure this is going to change, given because this came out on Thursday. We didn't get Friday's action incorporated into it, or Thursday's. We just got this action here. So people were a little bit more bullish because it was Monday, Tuesday, Wednesday looked good. Thursday looked good too, but then Friday totally destroyed everything. Okay, so bearish now. Let's get into the macro section. Okay, this is a little bit more interesting. We had a lot of macro coming up, some useless, like the first thing that we had is the building permits. Nothing big, 1.46 million. Still within our range, and they're not really collapsing like they do before a recession. So the building permits are okay. We also had initial claims on Thursday. Came out at 224,000. People are not filing for unemployment on a massive scale like they do before. Well, we don't have the max, so well, if we go to the Fed, you'll see that they're not filing for unemployment in crazy numbers, okay? Otherwise, this would be much higher. Okay, we also had on Friday, so the first two initial job claims that we look at and building permits, we're in the okay territory. Now we're looking at GDP. Okay, the GDP growth rate came in for the fourth quarter of 2024, but it was expected to be higher, to 2.5%. That's great, within our 2 to 3% range of our macro, okay? What really matters is Q1 of 2025. People think it might even be negative. It could drop down to here, maybe, or even negative, okay? So that we have to watch for. That's going to come out later, okay, not right away. Okay, so it's going to come out 3 months later. So that's what people are freaking out on. Okay, still a nothing burger right now because who cares about Q4 2024? Okay, so the other thing that came out on the macro, which everybody was waiting for, and what we should get into on Friday, there was a slew of data, of macro data. First, it was the PCE. Then we had University of Michigan consumer sentiment, then University of Michigan inflation expectations. And that's what really tanked the market, the last one, the University of Michigan inflation expectations, which we will get into. But first, we had the consumer sentiment, which was at 57. That is a very low number. It was going low in February, and that's a pretty low number. I mean, to see how low that is, we'll go to the Federal Reserve database, and you can see here. Well, we have February 64.7, but this is it hasn't been updated on the Federal Reserve's website yet, but it's at 57, which is, if you can see where my cursor is, it's around here, okay, because that's 50, 60, and this is around here, which is near lows. Like, these are extreme lows. Okay, the July 2022 low, and you also had here the 1980 low. Like, these are extremely low sentiment. 2008, it's even lower than 2008. I mean, come on. That's like, so we're getting to a trough, a bottom in consumer sentiment. People are really, really negative, with the market down basically 10%. This is what this is telling you. Is it a trough? Can we go down? We've never seen a print below 50. Can we get even lower than that? Lower than the pandemic, which literally closed down half the economy? Let's see. We're approaching low levels, in my opinion. And this tariff thing is crazy, but will it result in the market going down 20%? I don't know. We'll see. But with extreme fear happening, I don't know. We're already there. I don't know if there's any more selling to be done, but we shall see. So the big thing that we should look for is the PCE. Okay, the big thing that came out first was the PCE, which is the Fed looks at the core PCE, which was 0.4% higher, and they were expecting 0.3. That was the core, and the headline PCE month over month was basically 0.3%. They were expecting 0.3. It was basically in line, so slightly hotter. Okay, but that came out in the morning, like pre-market. So, and the market, if you can see, in the pre-market, we'll dig into this Friday candle, 15-minute chart. You can see here that it opened up lower 9:30, but it wasn't that. The market was at SPY was at 565-ish, and it stayed there for the whole time until 10 o'clock when it really started tanking. So when the PC number came out pre-market, the market was down nothing, very little. It looked like it was going to hold for the day. But then at 10:30, we got this number. We got the University of Michigan 5-year expectation number, which was at 4.1%. Last time they were expecting 3.5, which is crazy. And now people at the University of Michigan, probably Democrats, because they hate Trump, but it doesn't really matter, because they expect inflation to be 4.1%. 5-year inflation rate, 4.1%. This is just them acting out of fear and projecting into the future. This is not a really solid inflation metric, but the market took it and ran with it. That was an excuse they needed to really sell off the market. But so that's why I really don't look at this. Okay, and if you look at their 1 year, the University of Michigan inflation expectations for 1 year, they think in 2025 it's going to be 5% inflation. We're at 3 point something, and they think it's going to be 5%. Okay. What is the real 5-year inflation rate? We look at the break-evens for that. The 5-year inflation rate. It's 2.6%. So they're thinking that the 5-year inflation rate is 2.6, whereas the University of Michigan thinks that's a 1 year. Let's go back to the 5-year. Thinks it's at 4.1%. So they think it's at 4.1, whereas people that make a living trading the markets, the bond markets, put it at 2.6. So this is an inflated figure. They think inflation is going to rip to 5%, literally double what it is right now. That's crazy. That's just them fear-mongering and projecting into the future linearly, as if that only could happen if we start printing money again. If anything, the inflation is going to stay around 3.3% or whatever it is, the 1 year inflation, whatever the 1 year inflation rate is. But it's not going to be 5% or for 2025. That's like, even with tariffs, that's not going to happen. It's impossible. Okay? So unless you print money. Let's get back to SPY. So this is what really, let's get rid of the, let's see a cleaner chart here. Let's get rid of the averages. This is what really fueled this after 10 o'clock, this drop right here. Okay, literally it was staying around 575, this support level, 565 I should say, 64-ish at this support level, and then on Friday it tanked based on this macro print of the University of Michigan 5-year inflation expectations. Whatever the case may be, people were still looking to sell and dump. They're still very fearful. They just took anything, they grabbed on it, and they used it as an excuse to dump. Okay, so that's the macro for this week. Okay, start off well, but the slew of macro data, especially inflation in the end on Friday, tanked everything. Okay, so let's go to the last section of this presentation where I talk about things that interest me. Okay, first let's look at MicroStrategy. Why? Well, they announced another financing. This is Monday. Okay, they announced not a financing, excuse me. They announced that they bought another 6,911 Bitcoin between March 17th and March 23. Okay, at an average price of 84.5 thousand. What's Bitcoin? Bitcoin is around that price. So they were buying it around this level, 84.5. Okay, and you can see this is Monday. Let's mark it. This is the Monday on Bitcoin. As you can see, Monday, Tuesday, Wednesday, Thursday, Bitcoin was holding the whole week except Friday. Everything happened on Friday. But Bitcoin was doing relatively well for the whole week, as was MicroStrategy. Better than Bitcoin, going up, except Friday gave it all back. Okay, and Saylor announced that he's going to issue preferred shares. Okay, they were sold at $85 the preferred shares with a 10% coupon, I guess. So they got about $700 million in proceeds, and he used that to buy Bitcoin. So he's doing the same trick again, issuing debt, or in this case, let's say hybrid debt, preferred shares, like between debt and equity, to buy more Bitcoin. Okay, it could either make a lot of money or it could bite him in the butt coming forward. So we'll see. So on Friday, MicroStrategy dumped everything. Okay? But it was interesting to note that it was holding up before then, as was Bitcoin. Okay, depending what happens to the market going forward, we don't probably. I'm expecting, like I said, a gap down open, probably an exhaustion low, on heavy volume. Like right, what was this volume right here? Like 125 million shares minimum, something like that. I'm expecting, and I hope it breaks below this, like a real gap down with huge volume. Buyers need to step up. Otherwise, this is still bearish. Okay. So that was a little Bitcoin thing, but the most important thing that I would like to look at right now is certain commodities that are actually tariff winners. The market is a tariff loser. Well, these commodities are tariff winners. First, let's start with silver. We haven't spoken about silver in a long time, if at all. I can't remember if I did, maybe briefly. But as you can see, going back, silver here is getting up to its high of almost $34.80. This whole week silver was bid. But if you look back going further, you can see here that silver had an inverse head and shoulders pattern, okay, that broke above the previous highs. So if you want to do, I did a measured move here, technical analysis says that you take the high minus the low of this pattern, and then you project it higher. So the high minus the low was $12.16. So you add that to the $29.18, and you'll get a measured move of around $42. So silver, based on this breakout of an inverse head and shoulders pattern that I like, retested it, broke out, retested, went to highs, retested again, and now it's going to break this high here, thanks to this tariff situation. Target of 42. Technically speaking, who knows if we'll get there, but this is what the technicals say. So you have places in this market where you can make money. Silver I like, and I mentioned it on my Twitter a while back. Okay. The other play, of course, is gold. Gold just keeps powering higher. Look at that, new highs. 3,080 right now as we're talking. It's moving because gold is still being traded after hours. Look at this, it's a monster. Okay, I sold my last piece of GLD at 280 when it popped up March 19th, around there. So that's also my last piece, but that's when I was buying it last summer, around 223. Where is that? Here. When it was consolidating last summer around these levels, I bought the 225s, but the 225 calls when it was around here. It was dirt cheap. Okay, I got assigned them and I held onto them because it was still an uptrend, and I sold the last piece of that at 280. So that was a good trade. I'm out of my trading gold position. However, I haven't sold actual physical gold, and I'm still in the miners. Okay, so gold is unbelievably strong. Perfect macro backdrop for it. Central banks buying even before then. And now you had the tariff uncertainty. Gold is going to rip. It's going to go even higher. Okay, so that's another tariff winner. Okay, and one that I haven't really talked about a lot is copper. Trump is going to issue some tariffs on copper, 25% tariff on copper, so it ripped. Does this pattern look familiar to you? Inverse head and shoulders, breaking the high. I didn't do the measured move, but you can do it yourself here. The low here is at, let's say, 313, and the high is at 516, so it's like $2, let's say. So price $2, you expect it to go around the 716 level, around here. 716 level. That would be the measured move on a breakout. Look, it did break out. Let's make it clear here. It did break out, but then it's retesting. Okay, it can still retest, hover around here before going higher, but because of the macro backdrop, you have a fundamental case for being long copper, and the technicals support it. So you have fundamentals plus technicals on copper. I expect copper to go much, much higher. Okay, exactly like I said, 715, 716-ish. Okay, so let's just say $7 round number. In time, I don't know the timing, but it took a long time to consolidate. It could rip much, much higher. Okay, the longer it takes to consolidate, the higher the rip. Okay, so there are your three winners of the tariff wars: silver, gold, and copper. I'd also like to talk about high yield bonds because this is Monday. Okay, before we looked at it and we said that the high yield bonds are holding. So even though the market's tanking, since high yield, high risk bonds are holding, and spreads aren't going crazy up, they're up a bit but not super crazy high. The market is still sort of bullish. Okay, because when it's risk off, they sell high yield. Look at it. They did it here, and they did it in 2022. They did it in 2020. Here it just started on Friday to really tank, middle of the week. So, but it's still within the range. It's not really tanking and collapsing. It's still holding above its breakout level here of 78. The high HYG is the index that I'm looking at. The breakout point is around 78. It's like around 78.80 as of the close on Friday. So you should be noting it that it's going lower, but the fact that it's holding high, it's sort of a positive. Okay, if it starts breaking down, then it's a different story. Okay. So, and the reason for that is that we had the inflation expectations, the University of Michigan inflation expectations is what tanked this market, okay, which is like a survey that I don't put a lot of weight on. But what you should note is the U.S. 10-year yield on Friday went down, not up. If inflation expectations actually were up, okay, we should see this go up. Maybe it was forecasting it before, but this is what happens when inflation expectations, like remember the bond vigilantes, that's what happened in September of last year. Bond vigilantes came in and said inflation is going to stay high. Boom, you would have this kind of move and then sustained. Not even close. Friday went down. So it's just telling you that this University of Michigan inflation expectation number is bogus. Okay, it's just emotion-based, not really fact-based. We saw the 5-year break-evens are at 2.6%. It's not 4.1%. Okay, which is double what it is. Otherwise, this should be up here. The U.S. 10-year would be at 4.85%. If inflation expectations were at 4%, it should be at 5%. Okay, it should give you some kind of like return above the 4% level. Okay? So no. The U.S. 10-year is telling us that somebody's wrong. It's either the bond market or SPY that tanked on these inflation expectations, thinking that the rates are going to remain high to combat inflation. So these guys think it's very bad. The bond market doesn't think it's that bad. Who's right? Well, time will tell. We'll see. So that is the story for the week of the 24th. It started off well, except Friday destroyed everything. We saw the tariff losers, equities, and we saw tariff winners in silver, gold, and copper. We saw high yield sort of holding, which we should gives us some hope as contrarian bulls here. and we saw the U.S. 10-year yield fall, not increase. So that is where we stand right now. Looking forward to see it next week if we have that exhaustion gap lower. And until then, see you guys later.